Today on The Bottom Line, will Apple stock resume its climb? How big can Netflix get anyway? And RBC's Helima Croft on oil prices and the collapse of Venezuela. Hello everyone, welcome to The Bottom Line. I'm Henry Blodgett. We're here at the NASDAQ market site in Times Square. Big thank you to Fidelity Investments for presenting the show as always. We have a great show this week. We talk about the amazing stock market, which keeps powering higher. Check in on Apple, Tesla, and Netflix, and then talk to Helima Croft of RBC about oil. Big things coming in that market, she says. Let's start with the market. New highs for both the S&P and NASDAQ this week. The market is strenuously ignoring the Trump show in Washington, which is seemingly mild entertainment, but not substance enough for investors to change what they're doing. One question is, when you have a period like this, where we have super low volatility, market just marching up, is ultimately, can anything derail this? The answer, unfortunately, usually is yes. We'll give you one of those things, brought out by Baupost, a hedge fund this week in their quarterly letter. And I promise you that when we are in chaos and the market is in free fall, we will also talk about things that could turn that around and make it good. We're not a doom-saying robot here on the show, but just wanted to point out this letter, which was broken by Business Insider's Rachel Levy earlier this week. Basically, Baupost's point of view is, look, this is the calm before the storm. Every time you have such low volatility like this for such a long period, ultimately it leads into a market top followed by chaos and huge volatility. And the reasoning that Baupost gives is that there are actually a lot of funds that are tied to low volatility and making huge bets on that. And when volatility begins to pick up, basically they have to sell positions to raise cash, to meet margin calls, and so forth. So it can feed on itself very quickly. So from their perspective, it's a great quote that they summarize it, the market is. They basically say, look, we remain in a market that is broadly expensive and largely indifferent to risk. No one should be lulled into a false sense of security by this illusion of stability. So hopefully the market will keep going up, but keep that in mind as we go. The most important stock in the market is arguably Apple. There's a big question as to whether Apple will now continue on its march from 150 to 200. It's had a wonderful year as we go into the iPhone 8 cycle, the big new iPhone that's going to be released this fall, everybody expects. But recently, Apple's actually been lagging the market a little bit, and there are a couple of concerns around that. One is that the launch of the iPhone will be delayed into October. The other is that the rumors are that the iPhone will be priced at $1,000, which is well above the current iPhone, and that ultimately people will not pay for it, and so you won't have such a big product cycle as expected. So let's look at those. Can the market continue? Can the run continue? First, it's important to understand what the delay concern is. We're talking about a question of whether the iPhone launches at the end of September and therefore hits the third quarter for Apple, which is their fiscal fourth quarter, or launches in October and therefore doesn't come in until the next fiscal year. And where this will matter is on August 1st, when Apple reports its calendar second quarter earnings. The guidance that Apple gives will depend heavily on whether the new iPhone launches at the end of September or in October. And so very easy to imagine that people are startled and disappointed by low guidance if the iPhone is going to launch in October. Important thing to remember is long term, this is irrelevant. Doesn't matter. We're talking about a week or two on either side as long as they launch the phone in October. We still have a huge calendar fourth quarter, so it won't matter, but it's something to watch out for on the call, is the guidance and understanding when the phone is expected to launch. Second question about price and features. Apple is expected to raise the price of the phone to $1,000, which will drive up the average selling price of the iPhone, make it even more profitable. A lot of folks are expecting that this will be a super cycle where we have a new high for iPhone sales, but Wall Street's actually in disagreement about this. Lots of folks think that the market is saturated. Wall Street is too optimistic in thinking that Apple will sell almost 250 million iPhones in 2018, and ultimately think that folks are overshooting. One analyst in particular says he thinks they'll only do 230 million. Morgan Stanley's Katie Huberty says 266 million, so a big wide range. But on the stock, in my experience, and in looking at how Apple stock has performed on other big iPhone launches, what you want to do is buy the rumor and the run-up, and then don't stick around for the actual news. The past two big iPhone launches, the stock has run up in advance and ultimately peaked in the fourth quarter before we get the results on how many iPhones are selling. So in other words, if the stock is going to continue its run toward 200, which would make it a first trillion-dollar company, it's likely to happen in the next quarter or two, and ultimately next year's news will be old news at that point. So the story still seems intact. What is the bottom line on Netflix? Company reported earnings this week. Staggering growth of subscriptions, especially overseas. Stock had a huge run to a new high. How big can it get? How far can it go? The stock has been hated for so long. Ultimately, what is the bottom line? The bottom line with Netflix is that Netflix is what you should think of as a modern TV network. It has two huge advantages over legacy TV networks. The first is that it's just much better and more convenient than a traditional TV network. You can watch what you want to watch, wherever you want to watch, on whatever screen, whenever. You can log off of one screen, pick up another in a perfect place. Netflix has built a wonderful technology. It's super convenient. No more tuning in at a particular time or futzing with a VCR or what have you. It's just an incredible technology and service. And then secondly, and most importantly, and this is something a lot of folks who have followed Netflix have missed, Netflix has the same dynamics as Amazon and Facebook and others, where ultimately it can be vastly larger than people initially think. Because when you look at a legacy television network is limited by time. There are only 24 hours in a day. Has to show the same programming to everybody over that period, can only build so big an audience, and therefore only have so much money to spend on investing in content, which is what drives the viewership. Netflix, on the other hand, can theoretically show a different program to every individual that watches it at any time, and therefore has almost an infinite amount of shelf space for having new content. So Netflix literally could have 1,000 times as much content as any standard TV network if it can find ways to pay for it. And the amazing thing about Netflix in recent years is the content investment budget continues to increase to the point where Netflix may spend $7.5 billion this year on content, already dwarfs HBO and traditional networks, actually even closing in on Disney and ESPN, which are somewhere around the $10 to $12 billion range. Ultimately, if Netflix continues to grow, it should be in a position to spend vastly more money on content than any other network and basically have something for everybody to watch. We don't all have to watch the same thing. And the price point, if you look at least in our household, everybody watches Netflix. We all pay with one single account. If at some point Netflix wants to roll out the family plan for $10 or $12 a month, our family will sign up so quickly. It'll be a very smooth transition. So ultimately, there's pricing power there as well. So if you think about how big Netflix can get, right now there are about 750 million broadband users in the world. It's probably going to grow to 2 billion. Netflix has 100 million subscribers. Mark Mahaney at RBC sees that growing to 160 million over the next few years, thinks that can take Netflix stock to $210 a share over the next couple of years. So lots of upside and potential left in Netflix. Don't assume they've saturated the market. That is the bottom line. Oil prices have been so stable for so long that you may have stopped paying attention, but that would be a big mistake, according to our guest, who says there are big changes coming. Helima Croft is Managing Director and Head of Commodity Strategy at RBC. Helima, you're very worried about Venezuela in particular.
Yeah, I mean, we've had this discussion about who would fail first, an oil company or a sovereign producer? And we look like we're really reaching that inflection point in Venezuela. They're facing new looming sanctions from the United States, potentially being banned in terms of being able to place their barrels into the United States. Their economy is collapsing. We have a general strike called for Thursday. And it really looks like this country may really implode as we go into the back half of the year. And the question is, what does that do to Venezuelan oil production?
And obviously a disaster for people in Venezuela.
Yes.
You have the good fortune of not being there. What does it mean for the rest of the world? With respect to oil prices, what does it mean for U.S. oil producers?
I mean, Venezuela currently produces a little under 2 million barrels. It has the world's largest proven reserves. I mean, it is a very important producer. 10% of U.S. imports come from Venezuela. We had a situation in the early 2000s where we had a massive general strike. We lost millions of barrels of Venezuelan production. And are we potentially going to see a return to that type of situation? So are we going to see geopolitical risk and oil disruption come back into the market? And we always said these countries had very limited shock absorbers. And the longer we had this downturn in prices, we were eventually going to have a country fail. And we think we're really reaching that point now with Venezuela.
And so are we going to have big geopolitical ramifications? And if so, what does that mean?
I mean, I think it's very important for, obviously, Venezuela. It's important for the region. What if you get some type of refugee crisis coming out of Venezuela? Is it destabilizing for neighboring countries? But again, I think it's very interesting for the oil market because we've been so complacent. There's this view that with U.S. production, that we can basically weather any geopolitical storm. And so I think that theory is going to get a test in the coming months if we start to see Venezuelan production, which has been trending steadily downward because they can't pay service companies. They can't obtain the diligence that they need to basically dilute their heavier blend to market it. They can't pay their oil company workers on time. But do we go to a situation where we go from losing 200,000 to 300,000 barrels year on year to losing 500,000 or 600,000 barrels of production? I think that'll be a very interesting test for the market.
And if we lose that production, do prices then rise?
I think yes, and I do think we will get an initial rise in prices on that. And then it'll be an interesting question of like how fast is the response mechanism. I mean, one thing which is different now than in previous periods is we do have a lot of oil still in storage. I mean, the big issue right now for why we're in a depressed oil price environment is we still have this massive inventory overhang. So that is effectively spare capacity. But again, if you lose significant quantities of Venezuelan production, that will have a price impact.
So take us to the Middle East, the other hotspot geopolitically. Visits to Russia.
Right.
What happens there?
Anything but tranquil, the Middle East. I mean, what I think is amazing, it's the changed universe from when I started looking at oil and geopolitics, at the CIA in the early 2000s. I mean, if you had a situation where you wake up one morning in June and you have a country like Qatar essentially being subject to a blockade by its powerful neighbors, that would have been a pretty big event in the markets. And the market has largely shrugged off things like Qatar, but it doesn't mean the Middle East is any more tranquil. So the interesting question will maybe there is, do we start to see any type of disruption out of the Middle East because of these tensions that are going on? I mean, these were countries post-Arab Spring that massively ran up their social spending to double down on the bargain with their citizens, where they would trade, loyalty for prosperity. Now these governments have had to basically slash benefits to their population, and so it is a new negotiation they're having with their populations. It'll be very interesting to see what is the path in terms of stability in that region.
And so what is the outlook for oil prices?
I mean, the problem for a lot of these countries is the outlook is pretty muted going forward. I mean, we see prices grinding higher, but not galloping higher. So we see ending this year, in the $50. But, you had governments setting their budgets, pre-2014 at $100 a barrel oil is what they needed to make the math work. So these governments are going to have to get used to, for the next couple years going forward, $50 oil, $55 oil. Unless we get multiple countries falling off a cliff, you're probably not getting back to that $75 price environment.
And what's amazing watching the oil market from afar is we seem to go through these periods where people decide, we're done, we've found the stable price. For a long time it was $20 a barrel, then it was over 100, peak oil, we're done, the price is just going to go to the moon, now it's crashed back down again. Where are we ultimately going to settle, and what does it mean for peak oil? Like, are we ever going to move to a world where either oil goes to $1,000 a barrel or nobody uses it anymore?
What I think is so amazing is we've gone from a period where people talked about peak oil to now peak demand. And that, I think, is the lingering concern in the market. Are we going to be essentially moving beyond the age of oil because demand is just not going to be there? And I think that is one of the most interesting debates. And I think it may underscore why we're seeing certain governments in the Middle East hedging their bets by trying to monetize their national oil company assets. The focus is on electric vehicles. What is that going to mean for demand?
And so you are a perfect person to answer that question. Have we hit peak oil demand? Is it going to drop from here?
We see there are some bright spots in the market. We don't think it's entirely doom and gloom for the traditional oil producers. The bright spots are places like India. India is where you're going to potentially see driving oil demand growth, because in some respects, India looks like China in terms of seeing demand across the entire barrel as that government tries to move millions of people out of poverty, create a manufacturing sector. I mean, that's where we really see demand growth for oil going forward. I mean, just look at vehicle penetration rates in India, 14 to 15%. You look at Western countries, 75, 80%. A country like Brazil, vehicle penetration is like 30%. You go back to India, again, 14 to 15%. Like 70% of that is two-wheelers. So we do have amazing capacity to see oil demand growth in India. Even in China, it's been more muted as of late. It's been more about gasoline demand. But you just look at vehicle sales in China, they continue to grow. And if you look at the biggest component of vehicle sales in China, it's SUVs. So yes, this is a place where electric vehicles are gaining market share, but it's still only 1% of the Chinese auto market.
And is that, so in other words, oil demand is going to grow.
Barrels emerging market demand.
But globally.
Globally, again, this is what I think has changed about the oil market. It's not OECD demand growth that's going to fuel this market. It's going to have to be India and China. And then beyond India, the hope is there going to be demand in other parts of the emerging markets? Is Africa a place where we could see demand for oil? It's about moving people out of poverty, manufacturing jobs, people now using biomass to heat their homes. Can you transform these economies? People who want to see the bull case for oil, they point to places like India and Africa.
Electric vehicles, Tesla, folks who follow that stock, it's almost a religion around EVs and so forth. You point out that it's still a tiny fraction of cars.
Yes.
Are they ever really going to take hold? Or are Tesla bulls hallucinating?
Well, I think this is a really interesting question. I think a lot of it will come down to places like China. I mean, that's going to be, at what point does it become so cost effective that becomes what people switch to? I would say to you that you think about the traditional oil producers in the Middle East. I think they're hedging their bets. I went to a great event in Abu Dhabi, the Global Energy Forum. Abu Dhabi, major oil producer, UAE. But you know what we went to that night as part of the big party? It was at the Formula One track, and everyone drove Teslas. And you think about their sovereign wealth funds, they invest heavily in renewables. And so I think that's what's interesting, is you have these major traditional oil producers saying, we may need to hedge our bets going forward. We may need to invest in these type of technologies as well.
So Helima, Croft, oil price at the end of the year.
Gosh, we think in terms of WTI, we think we will be somewhere in the low to mid 50s year end.
Thank you so much.
Thank you for having me.
That's it for this week. Thank you very much for joining us, and thanks as always to Fidelity Investments for presenting the show. We'll see you next week.